Rahul Singh, Head of Research with Standard Chartered Securities, joins us. Rahul, good morning. Thank you for joining us. Rahul, are you personally surprised with the ability of this market to shrug off all the bad news? When bad news are coming, markets are making an excuse. When good news is coming, markets are reacting to that.
Well, not really, because if you see the kind of build-up till this rally, which really started in November, December, as a background, I think the way the external account came under control in the last quarter of last year really differentiated India from the other emerging markets, and that really started the whole looking back at India in a slightly more favorable light than compared to the other emerging markets. And obviously where India has got a little bit of help from is the way the other emerging markets have behaved, or the other governments have kind of tried to solve the problem, has been much more inferior to what has happened in India. So that is where it started, and obviously last couple of months it has been more related to the expectations around elections and politics and what might happen after May. And especially at the valuations at which some of the sectors and stocks were lying, which can be argued as deep value or multi-year lows, like some stocks in, say, oil and gas sector, which have rallied 25-30% since then, was kind of an ideal platform for that those kind of election beta, as I call it, stocks to rally and rally hard. And of course it pulls along the more quality beta names like the private sector banks and the L&Ts of the world. So therefore it is not entirely surprising, this rally, to me. The valuations today are at about 14 times FY15 earnings on the market as a whole, so not too expensive, but definitely not very cheap. So I think the consolidation is some kind of consolidation is due, especially as we start to get into very close to elections now in April.
Rahul, suddenly everyone is bullish on OMCs, oil marketing stocks. The general view on the street is that oil sector reforms have kicked in, these stocks are attractive, and if diesel price go up and if crude prices they come down, it's a win-win situation for OMCs.
Yes, I think the market was probably too pessimistic on the improvements which were already happening and beginning to show on their P&L since last 3 or 4 quarters. So if you see, there have been 14 price hikes, there's been a 15 to 20% reduction in the interest cost in these companies' P&L in the 9 months results. All these were not getting reflected in the valuations till about 3 months back, where stocks were trading at 0.5 times price to book. For example, HPCL was trading at 0.5, IOC was trading at 0.5, BPCL was slightly higher. They've all gone up to now 0.7 to 0.9 times kind of price to book. So they have delivered about 30 to 40% kind of returns. I think here some of that pessimism has got reversed. Whether this still reflects a full-blown optimism, I don't think so. But for that, obviously, elections have to deliver a reasonably good result for that kind of a story to pan out. So my sense is at 0.7, 0.8, 0.9 times price to book, these stocks would take a breather here. And obviously news like yesterday doesn't help in terms of the continued re-rating. So my own sense is that we won't probably see too much downside on that news, because the valuations are more about expectations for FY15 rather than what is going to happen in FY14. So it will obviously dampen the stocks a little bit, but we remain bullish on these stocks. I think the government has put in a fairly robust diesel price hike kind of regime, which is going to continue, and it continued even during the state elections and even after it. So there is no reason to believe that there is going to be any major disruption in that. And as long as that happens, and if you start looking forward into FY16, you really are looking at a scenario when diesel subsidies will be very close to zero. And the dependence on the government for any kind of subsidies would also probably be zero, which means that there can be a significant improvement in the working capital and below EBITDA from an interest point of view, from interest cost point of view. So that's really the kind of 18 to 24 month view which we are taking, and barring a completely fractured kind of a mandate in the elections, which I see as the major risk. Otherwise, these stocks still look good from a 12 to 18 month perspective.
Rahul, what's the sense that you're getting about banks? Because a lot of people are taking these sort of bets on elections, investing money into banks. But do you think the asset quality stress is here to stay when it comes to the banking pack? And, how would you approach the sector?
Yes, I think the banking sector stress in terms of the bad assets will continue. We are not in the bullish camp on banks. In fact, if one were to play for elections, there are much better plays out there to play for elections rather than going after PSU banks at this stage of the cycle. Because even if we do get a strong government at the center, we are staring at a pretty stubborn kind of inflation for some time. We are staring at pretty stubborn rates for some time, which means credit growth may not be that exciting. And the bad assets would take their own time to turn around or to go through the cycle of either restructuring or write-offs and so on. So we don't see any major lift in the fundamentals of banks even 12 months after, till about 12 months after elections. And if that be the case, then we would much rather stick with the private sector banks, or as I said, some of the industrials or capex related companies to really get exposure to the cyclical sector rather than going to the banks. And of course the oil sector and the PSU sector, where there is reforms happening, continue to be the top of our list in terms of the pecking order which we have for investors to position themselves going into elections and beyond.
The activity in industrials, Thermax, ABB, BHEL, Crompton. These are the kind of names which are sitting at a fresh 52-week high. Now we know that there are multiple challenges for the Indian power sector. So if there are multiple challenges for the Indian power sector, why are power ancillary stocks moving up?
No, I think it's all about expectations and the relative valuation. So if you look at, for example, BHEL on a price to book basis versus order to book to bill ratio, it's looking reasonably attractive. It is not kind of very deep value, but it is very, very good value at these levels. So if one were to take a slightly longer term view post elections, 2 to 3 year post elections, some of that mess could get sorted out. In fact, in power sector, like in oil sector, although it's not as clear cut as oil sector, in power sector we have seen some movement in terms of the regulators being much more amenable or practical about how to solve the problem of some of these stranded assets in the power sector. But obviously it's not a linear kind of a profile in power. You will have stops and starts, you will have the states going to the APTEL, and then you probably get these issues into the courts and it will get settled. But the point is, things are beginning to get sorted out. It's still little early in power. But one has to look at that in relation to the valuations which some industrials were trading at, and that's what has happened, that some of that deep pessimism has come back to moderate pessimism or cautious optimism kind of in power, in oil sector and some of the other sectors. Even for example cement stocks have gone up 20% in the last month or so, and that's purely because of what I said, that deep pessimism has been replaced with moderate or cautious kind of optimism.
If I just talk about large cap IT, if you have to pick and choose, let's say from HCL Tech, Infosys or TCS, which way would you lean? Where are you happy to allocate disproportionate amount of money? Well,
I would say HCL Tech definitely is our top pick, continues to be our top pick. Between Wipro and TCS, I think Wipro is looking better in the short term. TCS, of course, has many more growth levers in place over 12 to 18 month perspective. But if one were to really look at it from a this quarter perspective, Wipro actually looks the best of the lot, really, in terms of what quarter-on-quarter growth it can deliver. So I would say in the short term, HCL Tech and Wipro. Longer term, it will be HCL Tech and TCS.